Welcome to another VC Wisdom Pod with John Sun. John is the founder at UpsideDown VC. He's investing in flexible debt and equities and ecosystem builder live from London. I'm in Oaxaca, Mexico. And yeah, cool guy. I'm looking at his experience here and everything that he invested into, like probably a dozen startups there. Was a coach, was a mentor at Founder Institute, creator at some point. So very diversified experience right there. I'm eager to jump in the conversation. This podcast, VC Wisdom, is brought to you by bookwritegpt.com. If you want to take all your LinkedIn posts and make a nice book out of them, you can go to bookwritegpt.com. We allow you to do that in one click. John, welcome to the pod. Tell me a bit more about yourself and what you're up to nowadays.
Yeah, so I'm the general partner at UpsideDown VC. We provide opportunity capital to founders at the friends and family stage. And basically, we do it through one of two instruments. For slightly later stage founders, we utilize a pure safe note. And for at that bread and butter friends and family round, we have basically brought brand new instruments over to the UK and Europe. That is basically an income share agreement safe note blend that allows LPs to have downside protection and founders to retain more of their ownership by having the opportunity to buy back equity when their income reaches a certain threshold. So basically, we had a dream and strategy of producing something that would give founders maximum flexibility.
Tell me about the moment you shifted from founder to VC. What was that moment and why did it happen?
Yeah, well, I never really actually intended on becoming a VC in the first place. I think what happened was I've always had a passion for helping founders and creating opportunities for founders, because during my founder journey and subsequently on the side as an ecosystem builder, I realized that access to capital was very, very unequal. And I think particularly after spending a lot of time in various circles, I wanted to find a way to open up more opportunity to founders. And basically, this was kind of like when we started initially. We collaborated, I think, with a US firm called Chisos Capital. So it's CHISOS. And they actually invented the income share agreement safe note blend instrument to invest in idea stage founders. And basically, all we really wanted to do was to innovate within VC. So we were thinking of ourselves as we wanted to introduce an innovative product to venture, and we wanted to basically bring an innovative strategy that would be great for founders and great for the ecosystem and great for limited partners as well. So I think that's how we thought of it. We really brought a builder's mindset to it, and I think we've been investing off our balance sheet for a while. So, and yeah, just giving a lot of talks, giving a lot of presentations, and talking to a lot of people about just our innovative, non-power law way of investing.
Right. And you invested in 7 companies since then. Is that what you do full time, Upside VC?
Yeah. I've been working on it for full time for the last few years, and been building various communities on the side of used to be founders, now currently investors, and that really helps with a lot of our deal flow and similar stage and later stage access.
And why only 7 deals in 4 years, I believe?
It's simply basically a limit of bandwidth of capital. So basically, investing off of balance sheet means that we don't have any limited partners yet at the moment. So that means that to initially build a track record that would make us attractive to limited partners, that means that we have to pick our bets relatively carefully, right? Where we want to be headed long term is we want to be a very, very high volume investor and ultimately give lots of opportunity to many, many different founders using our unique way of investing. However, the way that venture goes is your initial track record matters very, very much. And we believe to the best of our ability that the 7 that we have invested in will allow us to showcase our initial talents and abilities as alternative capital investors.
Okay, my question is more like, how do you survive like the past 4 years, like without like cash flow? Because these are long-term exits, sort of. So how do you make sure to stay afloat financially?
Oh yeah. Well, we have. If you're talking about specifically myself, I have like passive income and savings that I've done over the last few years. So I've invested in some real estate, and I think that's helping me generate some income. So that's sort of like helped take a little bit of pressure off of me on that end of things.
And usually, how long is the exit? Is it 5, 10 years? What are you aiming for?
Well, I think the ones that are headed down an exiting track, I think we're thinking about 5 to 7. Probably 7 would be the median. One of them is actually already paying us sort of like income share agreement flexible debt money already. So actually, we can receive smaller rates of returns relatively early from our flexible debt instrument as soon as founders and companies start earning a good amount of monthly recurring revenue relatively early. But I think if we're imagining sort of like that traditional sort of like private equity style exit or beyond to IPO, I think most likely it would take about 5 to 7 years for sure.
Right, and tell me about some of these investments. These some of the favorite ones that you invested about. I believe there's an electric one. Then there's Under the Eyes, Gig Bridge. Tell me about like which ones you're most bullish about.
Yeah, I think the two that are doing the best within our portfolio are the Airbnb for electric cars platform, which is Voltric, and a B2B white label solution for electronic SIM cards platform, which is Zim. And both are headed down a really good trajectory because we invested in both of those companies really, really early. And so one of them has turned over 1.5 million AR in 2024 after only being around for 2 years. And the other company, Zim, has done over 450K GMV and has raised, I think, 2 or 3 rounds of financing since we first put a friends and family round style check into them. So those are 2 companies that we're pretty excited about. The other companies are, they're, I think, require a little bit more patience, but I think they still have a lot of promise within them as all portfolios go.
Right. And what are you seeing change in the age of AI as a VC? How's that impacting the ecosystem?
I think the biggest thing is just our eyes have to be open far wider and very, very cognizant to the rate of change because I think things are changing much faster than ever before. I think what was a technological moat today will not be a technological moat tomorrow and will not be a technological moat next week. So I think that's the first thing, is to be very cognizant of the rate of change. The second thing is to be very cognizant of like what is a true technological sort of like, if you want to call it data set innovation versus GBT wrapper, as like a lot of people, relatively talk about. And I think 3 is actually the sort of like the lessening attractiveness of SaaS, just because I think although a lot of AI driven code platforms have their limitations, but I think they've become more and more, they've been improving at a relatively fast rate. So much so that, that vibe coding is quickly becoming a very viable replacement for regular development. And so I think that roles are changing. What will count as long-term moat in technology is always changing day by day. And I think it's an incredibly exciting time. It's probably the most competitive time to be a founder ever. And more importantly, I think, VCs always need to be on their toes for sure.
And do you think that bootstrap founders using AI agents instead of employees, do you think they'll still require VC capital?
I think, well, if you're speaking from our point of view, because I think we are relatively biased, but I think we've always been excited about this concept of seedstrapping, which is actually something that we've always encouraged our founders to do. And we've always, any founder that's ever come to us, just run-of-the-mill advice, we'll always recommend them to seedstrap. And that basically, it's a fancy term everyone talks about on LinkedIn nowadays, but we've believed in it for a long time, which is founders raise as little as possible to build as small of a team as possible and get to profitability as quickly as possible, and then actually accelerate their rate of exit with a very, very sort of like lean sheet of resources. And I think it's something that, that we've wanted to happen for a long time. I don't think that it's healthy for founders to take endless rounds and rounds and rounds of capital to sit there on this treadmill and then to justify spending money for the sake of spending money. I think that it's time that founders got back to basic economics, prioritizing profitability first and prioritizing capital efficiency first. And I think like in the age of AI, I think that's a very positive development for the startup ecosystem.
Right. And will AI change the 1 in 10 home run strategy of VCs? Will it bring the investments, the home runs to, I don't know, 3 in 10? Do you feel that it will impact that if we're just making better decisions, if it can predict what will happen and make very complex calculations and projections and simulations? Do you think that should change that core VC model?
I think the tricky thing is it's going to be harder and harder to find startups that will sort of like hit that home run stage, if only because the rate of change is so quick and the level of competitiveness is so much harder, is so much higher, right? So I think on one hand, we're going to get much better at analyzing, both on the founder end and the company end. On another end, I think the ones that are going to make it are the ones that are able to preempt the speed and rate of change earlier and faster than everybody else. And that, I think, in itself is relatively more challenging to predict, because I think a lot of recent, innovations that, a lot of forecasters have projected would happen, longer down the line have been happening, in half the amount of time. So I think, so that's where I think like it will probably come down to a more, if you want to call it like median rate of success. And I think the numbers will end up balancing themselves out.
How did you meet your partner, Sam Marullo, and how do you guys complement one another?
Yeah, we met in the tech ecosystem, and I think he was an ex-family office investor, so he comes from a slightly different world to myself, even though we've both been operators. And I think the way we complement each other is, I think, through just our overall skill sets, in the sense that I think that I'm relatively younger and I come from a minority background, and he's relatively older and comes from a little bit more of that old school world background, which I think, really, which I think helps us to overlap and cover every aspect of the ecosystem. And I think particularly he's been helping us a lot on the fundraising end, whereas I've mostly been contributing a little bit more on the deal flow end. So I think just if you imagine like all the things that are needed, for a venture fund to succeed, I think that we've both got both ingredients covered. I think both from a raw skill set standpoint and also from a personality standpoint, in the sense that I'm a little more detailed than he is, but I think in certain ways he sees the big picture a little bit more. So I think that's kind of how it goes.
Right. Tell me a bit more about your podcast that you had. Like, what was your thesis behind it? And you're saying that you're still building communities nowadays. So how does that fit into your whole community building strategy?
Well, I think there was a point where this was a little bit of a COVID lockdown experiment, but I was interviewing practitioners around this idea of pretend prototyping, which if you squeeze it together is prototyping for short. And I think it actually informs a lot of what we do now. And that's basically the idea that, okay, how do you intelligently validate business ideas without, resorting to chucking lots and lots of money, right? And I think to this day, I still see it, especially amongst like a lot of early stage founders that resort to purely relying on user interviews. and conversations with their target market as a basis for validation. When in reality, I think the most important metric for validation is, how many people can you get to pre-order and put money for a non-existent product because they're so excited about your idea. And so there's been some experts around the space of business idea validation, and like those were some really, really great conversations. In terms of startup community development, I think if I trace some things back, I ran a couple meetings with Product Hunt. That was in early 2020. Did some stuff with Techstar Startup Weekend. Also, that was, I think, mid 2020. Did some stuff with Zebras Unite. If you're familiar with what that is, that's Zebras Unite is a impact. It's like a community of impact founders. And I remember leading their London chapter for 2 years, running their meetups and getting a chance to meet a lot of impact first London founders, and kindly reminding them that profitability is just as important as impact, because sometimes founders will tend to swing into either direction. And then also getting involved, running a couple meetups with Indie Hackers London as well. So getting a bit of a broad sort of like startup ecosystem spread. Nowadays, what I do, it's a little bit more informal, but basically I run a couple of investor communities on WhatsApp, and that's been really, really helpful in the sense that being able to like sort of like map out every investor of every stage in the country, in the continent, and having some in US and Asia as well. It helps a ton, especially like when you're looking for like co-investors and like and other people to help your portfolio company get great deal flow. And I think the ecosystem is better when everybody's more transparent like that. So those are the things I believe in.
And tell me about the WhatsApp group, because I have my WhatsApp group for existing clients and a bunch of other communities. I'm really bullish on building communities there. Do you think it's the best tool to build communities because everyone has it's instant, and you can react with emojis, can post a bunch of things in there. So tell me about your vision about communities, one, and two, about using WhatsApp to build them.
Yeah, I'll actually answer them in other way around because I feel like it'll help my answer flow a little bit better. But I think WhatsApp is great in the sense that like everything feels far more intimate, and everyone feels like they have access to each other a little bit more. I think there are certain people that feel a little bit frustrated with the idea of WhatsApp communities just because like if you imagine like merging work WhatsApps with personal WhatsApps, with kind of like this gamut of endless groups that get created, some for events, some for stage investors, then birthday parties, and then and then your family, right? So I think while people are very cognizant about digital noise, I think in the end of the day, like this is, to me, it's still the most intimate way to get deals done, and people feel the most connected to each other from an energy level. I think other platforms, I feel like, struggle to achieve that. I think there were like, for instance, like Slack, Circle, Discord, right? I think those platforms struggle to achieve the same level of intimacy that WhatsApp is able to build, even if they help certain types of people be able to separate different levers of their life a little bit more. And I think if you think about and if we're talking about the long-term future of these communities, I think it depends on what the members really want. I think sometimes less is more. And I think some people that run communities feel pressure to run lots and lots and lots of different events, find lots of mechanisms to bring everyone together, like organize automated one-to-ones, fill out lots of forms and all this structured stuff. I think some communities function a little bit better as a little bit of a Reddit style forum where people just loosely send each other things and help each other out. And I think sometimes it functions really, really well on a minimalist level, both from an admin standpoint and from like an official sort of like standpoint. I think it really depends per community. I think every community is different. Every person in every community wants different things. And I think as an admin, you have to be very, very cognizant of that. I think the only thing that we really police within our communities is who goes in and who goes out. Just making sure that like we limit the amount of spam and the amount of like rubbish that gets posted.
Love that. What's next for you? What are your goals for this year?
Yeah, we're working on our first close. So I think we've been in touch with some LPs, and we're really looking forward and hoping to achieve the kind of minimum first close that we're hoping to. In a couple weeks, a couple weeks from the day that this podcast is being being recorded. So I think we're heavily anticipatory to that, and I think like a lot of like our long-term future goals for the fund sort of like hinge on that. So we're really hoping that we can get the minimum first close that we need to continue to build out our mission to democratize capital for all.
Thank you, John. Where can people find out more about you?
I think the best place is LinkedIn. Type in my name on LinkedIn. I'm really happy to add you, and I'm happy to have a chat if you love our mission, if you're excited about it, and if you'd love to contribute.
It was Jonathan Sun and Charles Cormier for another